Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The U.S. government is one of the largest holders of Bitcoin, okay? And I think that Trump was very clear in naming stockpile, not reserve. And I think that what he can do with an executive order is basically stop selling those assets that the U.S. government has accumulated.
The Trump tax cuts worked from the standpoint of economic growth, bringing investment back to the United States, and record wage growth, especially in those first 3 years pre-COVID. I think the key here is to lock in really the growth in that tax code going forward, making permanent some of the key business provisions that have begun to lapse. That's very key.
Just get the popcorn out. Because in my opinion, this is the start of this massive build out of AI capex that I think the street's massively underestimated. I mean, think about the 80 billion number from Microsoft, now you got Meta, and it's the multiplier. For every dollar spent on NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech. That's bullish for tech. And of course, with Trump and Stargate, I think it just shows this fourth industrial revolution just starting.
We got 1 hour to go until the market close. So let's take a look at the major averages here. Taking a dip as the day goes on, down 0.4% for the Dow, off 166 points. The S&P 500 off about 0.4%, and the Nasdaq down 0.2%. I should point out, if you look at the 4-day week here, and you see this 1.6% gain, if you go back in inauguration weeks where you have 4 days following inauguration, this looks to be the best performance going back to the Reagan inauguration of 85. So, today notwithstanding, we have seen a lot of enthusiasm, Josh.
Yeah, I mean, you got a bit of a breather, but you're hanging out right around all-time highs here still. To your point, you bring up the inauguration. I mean, it was interesting with President Trump this week, Julie, because when we talked about this, he was talking a lot. He was making headlines. He was, talking tough on the Fed, right? He's pushing for interest rate cuts. Yeah. The Fed should listen to him. But then there was other issues where there may have been talk, about tariffs, for example. But as we sit here right now, I mean, there was nothing concrete there, and you kind of wonder, okay, the absence of that, how much did that help as well? I mean, he didn't do anything this week that you would say, okay, it really rattled financial markets.
That's right, because although he did come out and talk about tariffs on Mexico and Canada that should take effect on February 1st, there was nothing with China. So that was sort of the worst fear of the market. But also, sort of reflecting what you're talking about here, we saw yields not really do a heck of a lot this week. That's been one of the big fears of the market, that we would see yields bump up. We're still at about 4.6%. And the other notable asset action, or one of the other notable things, was to see the drop in the dollar index, which is the biggest on a weekly basis that we've seen in some time. Crude oil futures on the week also trending lower, as he did some jawboning. At the very least, he used his speech in Davos to sort of say he wanted lower oil prices. So all of this has been very interesting. Bitcoin, by the way, which we're going to talk about later today, up on the week. Not a record, just shy of a record as well. But we've been also watching some of the moves within large cap tech. And surprisingly, some of them. Yeah,
it's surprising. And listen, you're kind of buckling up here because as we were talking about, next week you have big tech earnings.
Yes.
Not just big tech earnings, you also have the Fed. But there was a lot of news for investors in these names too. We talked about, for example, the Stargate AI project. You saw investors very quickly there kind of make their bets, winners, losers. Some of that I still think shaken out. We're going to talk about that as well.
Yeah, we are. And just a quick check on Meta on the back of all of this as well, as that company came out and said it is spending far more on AI infrastructure this year, $65 billion, than even the highest analyst estimates that were out there. That stock is up, but sort of the broader stuff in the AI-averse or whatever, like it's interesting to see NVIDIA down on the day, because presumably it would benefit from Meta spending like that. So again, we're going to be talking about all this throughout the next couple hours.
All right, for more on the market moves this week, Michael Reynolds, Glenmead VP of Investment Strategy. Michael, we'll start here with, in your notes, Michael, you say the road ahead may be shorter than the bull market's age alone would suggest. Michael, what do you mean by that?
Yeah, thanks for having me on. We're looking at an economic expansion here that, as Yogi Berra would say, it gets late awful early out there. Classic signs of late stage expansion. I think investors are looking at that in combination with premium valuations and asking themselves, how much longer can we go on this bull market? But it's sort of interesting. We've gone through the data going back almost to the 1900s and have found that it's not age alone, nor is it valuations that really brings the end of a bull market. You have to sort of see something change the paradigm of the market narrative to see such a dramatic repricing to bring a bull market to an end. We're not seeing that just yet. But when you sit in a late stage expansion, you got to be looking for signals that those things could be coming from measures of excess throughout the economy. We're perhaps seeing some signs of that on the consumer debt side, particularly for low-end consumers, but not to the extent that we think is going to put this bull market at imminent jeopardy.
Well, and it's interesting, Michael, that you say all of this, because it's at a time where there is an attempt at a paradigm shift in the other direction on the part of the incoming administration and some of its policies, which are designed to sort of extend the economic cycle. What are the chances you think they will succeed?
Well, the rubber's hitting the road on Trump 2.0, and we've got a lot of these executive orders giving us a little bit more detail about what exactly he's trying to do, but still not yet certainty. We don't have a lot of details about what tariffs are going to look like in practice. We still don't really know the extent that deregulation is going to be able to be, a tailwind to economic growth. We do expect it to be a notable tailwind to growth, alongside with potential tax cuts. You have a couple things that could really drive economic growth and potential GDP higher. On the other side of that, though, you have a couple other things like the tariffs, like immigration policy. If you start seeing deportations to a meaningful degree, that could be an economic headwind. So you've got these sort of fighting policy priorities that we think are going to net out to a positive, but there's a lot of uncertainty around it, and it could swing in either direction pretty easily depending on their scope.
Michael, sticking with Trump, what do you make of the comments this week, Michael? He was talking tough on the Fed. He would demand interest rates drop. He expects the Fed, he said, to listen to him. What do you make of those comments, and what do you expect from the Fed next week?
Sure. I mean, he could say all he'd like on interest rates. He's allowed to have an opinion. But when it comes down to it, we still believe in Fed independence. And we think the Fed is going to do whatever it takes to meet their dual mandate. And there's no question about that from our perspective. In terms of their decision next week, we sort of think, if the Fed was, if when you became Fed chair, they gave you a remote that was able to control monetary policy, Powell's probably got his thumb over the pause button right now. I mean, we've hit this new regime where, he's got to be much more reactive to the data and looking at inflation very closely for signs of perhaps a reacceleration. And they don't want to get over their skis on this rate cut cycle, because history tells us when you go too quickly and inflation's still an issue, you can often see a reacceleration there. So slow walking from here is probably the name of the game, but there's going to be a lot of focus on the presser after the release to sort of get an idea of maybe where he's leaning for the next few months.
I predict some questions about politics that are going to make him cranky, but we'll see. Michael, put all this together for us in terms of strategy here. So given that we're potentially looking at late cycle here, is there a playbook that tends to work in these situations? And do you also sort of put some hedges on or some defensive plays?
In an environment like this, we think investors need to know when to pull the trigger on tactical decisions. And when you are in late stage expansion, you do see premium valuations. You often probably don't want to be taking large bets because this bull market can continue, but perhaps there's limited upside, especially after 2 straight years of 20% plus returns. So we're actively recommending to our investors to maintain a neutral risk allocation while actively rebalancing when perhaps you've got decent portions of your portfolio that have run reasonably well and may be sort of out of line with longer term targets. It's rebalancing that's going to be the name of the game here. It's really a risk management procedure at this point in time.
And finally, Michael, let's get your thoughts on big tech as well. You have a rush of big tech names reporting next week. Broadly, your expectations there, Michael, and how important are those reports to the broader market?
Very important. Next week's going to be like the Super Bowl for earnings. I think it's something like 40% of the S&P 500 by market cap is reporting next week. Our expectations are that tech are going to put in a strong going of it in this quarter, or I should say Q4. But as we look at the year ahead, I think the guidance is going to be so important from a lot of these companies. We've had an index like the S&P 500. Its earnings have really been driven by just a couple companies. You can call them large growth, you can call them tech, you can call them the Mag 7. It sort of all means the same thing. But looking ahead, there's actually some expectations to see a broadening of earnings results. So more companies just getting better earnings results in 2025, which tends to favor more diversified investment approaches. So, we're cautioning our investors not to sort of get too over their skis and avoid the pitfalls of concentration when perhaps there may be greener pastures ahead.
Michael, thank you so much. Appreciate your time. We're just getting started here on Market Domination. Coming up, Meta planning to nearly double its capex spending this year. We'll hear from an analyst on the other side about what that spree means for the industry. Plus, another round of earnings out this morning will get you caught up on some of today's top trending tickers, including shares of NextEra, Energy jumping. Stick around, much more Market Domination still to come.
Yahoo Finance is stationed all week at the World Economic Forum in Davos, Switzerland, and we have a big day of coverage.
The mood at Davos this year does feel more optimistic.
What do you want to see from the Trump administration?
We want a highly strong capitalized, strong liquid set of institutions in this country.
To see a government that's really focused on growth and being able to make the economy everything that it can be.
The U.S. economy is in by far the best position.
This is about unleashing the economic activity, primarily in the United States, and growth.
So I would say there's no doubt there's a lot of optimism.
I've seen robots in the streets here. They're doing demonstrations.
I saw a little dog. I took a photo. I think it was DHL, a little like robot dog.
Creepy.
It is creepy.
I'm working with the AI. I'm talking to it. It advises me. I ask it about how what I'm doing compares to my competitors.
When we went through just deploying phones in homes, it took decades to get to 50 million users. ChatGPT had 50 million users in 1 month.
Big tech companies, of course, have significantly invested in artificial intelligence. They've already spent billions on capital expenditures, but the spending spree far from over. Meta revealing it is planning now to invest as much as $65 billion in capex this year. CEO Mark Zuckerberg saying in a Facebook post that Meta has the capital to continue investing in the years ahead. Here with more on how the capex spend is shaking out for big tech and the ripple effect throughout all of tech, Mizuho America's desk-based analyst Jordan Klein is joining us. Jordan, and this number coming from Meta was a lot bigger than analysts who watch it were predicting. This coming on the week that we also got news about this Stargate program that could release as much as $500 billion eventually in AI infrastructure spending. Like, sort of, as you take a step back, how are you thinking about what this year is going to look like?
I think the phrase is going to be go big or go home, especially from these large cloud hyperscalers that are in this proverbial arms race to basically try to, get a lead and dominate this new AI market. And, their messaging is that there's too much to lose here to not spend enough in the early phases. And these data centers are really complex, they're really large, and they're expensive. Not only the building of them and construction with the power and the cooling, but if you're going to put the highest performance compute capability, like, for example, chips from NVIDIA, to be able to train these larger and larger models in a faster period of time so you don't spend as much on electricity, you got to really have a lot of capital. And let's be honest, if you look at Meta, they generate 85 to 100 billion in EBITDA per year, and their free cash flow alone is 50 billion. So yeah, it's a lot of money, but in Zuckerberg's mind, he's making a big investment and down payment on future growth.
Jordan, the question had been raised by some is they were just seeing these big numbers thrown out there, spend on AI, and no one thought it was going to stop. Some thought, listen, surely it has to slow the pace of it. Have you seen any evidence that it is slowing, Jordan?
I would say it's maybe not going to grow at the same kind of rate every year going forward. A company like Microsoft has already said don't expect the quarter-on-quarter capex growth to keep accelerating, and they're spending around 20 billion a quarter alone in capex. So yeah, I think on the overall growth rate, it's going to start to moderate just because you can't feasibly probably spend that much when you get up to the size and scale that some of these guys are spending. You can't keep accelerating that. You can't even find the chips and the people to hire to do it all. But that being said, again, I think you're going to see very large numbers for at least this year, probably into next year. And then you have the government now in the United States and other regions of the world supporting more data center build-outs. So I think that's going to keep the numbers higher for longer.
Well, and we were just showing there the percentage of Meta's revenues, for example, that are now going to capex, and it's a big jump over what we had seen and over what analysts had estimated, of course. And we sort of have flirted with the question of like when they're going to make that money back. And investors sort of care about that for a little bit, and then they don't, and then they do again, and then they don't. What do you think that cadence is going to look like this year in terms of, you mentioned Meta's investing for the long term. Like, how long is the long term, I guess, is the question.
It is a great question. They get this question on their earnings call repeatedly. Like, can you talk about the time frame and how you're going to monetize? I think what it comes down to for all these companies that are going to report revenues, give guidance, and then tell you to a certain degree, some more specifically than others, what they plan to spend is their revenue growth rate rising or falling? And for most of them, I would think, particularly for Meta, the growth is probably going to upside versus, come in line or below their guide. And as long as their operating profit margins do not come down sequentially, I think the market is going to be like, look, it looks like you're able to grow revenues, for example, Meta in the upper teens year over year, and your margins are, slightly higher as opposed to, peaking and coming down, will give you the benefit of the doubt. As soon as that narrative or that dynamic on top line growth and margins reverses, it's game over, meaning they're not going to get a pass. But I think most investors I speak with understand that this doesn't happen overnight. You can't just build a big data center. It takes multiple years, and you have to start now to basically get the facility ready to put the compute power in, let's say in 12 to 24 months. It's not going to happen overnight. So they'll give them a bit of a pass.
I'm curious, Jordan, how you see the mega AI trade and trend sort of changing in 2025. You know, is it still going to be all about the infrastructure, the hardware, the chips, or no, it's going to be ways that it evolves?
Yeah, I think that the dominant focus has been largely GPUs, you know, what NVIDIA sells, the chips that train these large models. Because they're the biggest company, they're generating the most revenue, and that's what people are buying most aggressively. I think a lot of this capex is going to start to shift. It's going to go into areas like inferencing, you know, memory to run these systems. And what I think is the most interesting is high-speed interconnect and optical connectivity. So how do you get the data inside the data center into these clusters to basically run the AI and then back out to what the users, you know, wants and requesting from it. And if you don't have a very fat, high-speed pipe, which is optical, and these new Ethernet networking standards, you know, it doesn't matter how fast and how high-speed your training product is. The bottleneck is going to be the data in and out. And so that's a lot of these companies that are going to be working, and that's where you're going to see a lot of, I think, new capex shifting over the next 12 to 18 months.
I know it's not happening right now, but it is interesting to see then, for example, NVIDIA falling today, even with this Meta announcement, even with the Stargate announcement earlier in the week. Is there anything we can read into that, or do you think that maybe just people taking some profits at the end of the week? What do you think?
Yeah, I kind of tell my clients not to read too much into these day-to-day moves. So much of it can be passive investing, retail, quantitative, ETF baskets. To me, it really has nothing to do with the fundamentals. I think underneath it all, I look at how the broader semi-sector is acting relative to the broader tech space. And what I'm seeing today is software catching much more of a bid versus semiconductors. And that to me kind of says semis have had a really big run this year. They're up a lot year to date, more than any other sector in tech. And I just think for whatever reason, some money's kind of shifting into other areas, namely software. And this changes every day or week. So I don't think there's anything underlying why it's down 3%.
Jordan, always really great to get your perspective. Appreciate it.
My pleasure.
Let's get to some movers now. Target rolling back its diversity, equity, and inclusion initiatives. The company joining several names like Walmart that have taken a step back from DEI efforts as well. On the flip side, Costco, contrarian, it defends its diversity policies, and indeed 98% of its shareholders voted to reject a measure that would have forced it to push back its DEI initiative. So, you know, sort of different sides of this DEI debate here, Josh. But Target really, you know, there has been obviously sort of private sector pressure on these companies. Now there is also governmental pressure to retreat from some of these policies.
Yeah, I mean, it is multifactorial, right? I mean, I think conservative activists got a lot more active last year when the Supreme Court struck down affirmative action in college admissions, and then of course you had the red sweep in Washington that only ramps up the pressure. There is an interesting question though, Julie, too, and there's been some good reporting about this, about to the extent that companies come out and they make an announcement and they might even remove the acronym from public material, they like remove DEI, the letters from an annual shareholder letter. But does that actually mean in practice they're ditching the practice and the policies? And I'm not so sure. I don't know, you know.
Right. I don't know either. I mean, well, for example,
I don't know how much. I mean, aside from Target, how much is
right?
It's obviously you mentioned it's much broader than Target at this point. I mean, it's multiple companies from multiple sectors. You know, to the extent like what actually is happening behind closed doors is interesting.
To your point, just one example. they have something called a supplier diversity team, which that deals with companies that supply goods to Target. Now it will be called the supplier engagement team.
Right.
Does that mean they won't factor in diversity at all with that engagement with suppliers, or it's just not that they're highlighting it
how much becomes
quite as much
how much
externally?
becomes different packaging and gift wrapping? I mean, it's something to follow.
I guess we'll see about all of that. But there was also an interesting story from Bloomberg that lawyers' offices are getting inundated with calls from these companies about how to proceed. So I'm sure that's also informing the language that these companies are using.
For sure.
Yeah.
All right. We move on. Now time for some of today's trending tickers sponsored by Tasty Trade. First up, a look at shares of Verizon, as that company does beat estimates on the top and bottom lines. All right, we're about 1%. Verizon also achieving its best quarterly result in more than a decade for additions in postpaid mobile and broadband subscribers. So Q4 results are in. They do beat what the street was looking for. Net gain of 568,000 monthly phone subscribers. That's a beat. Broadband, I'm just looking, they added 408,000 net broadband subscribers. Also a beat. Though the stock not doing a whole lot today, and frankly, we haven't done a whole lot over the past 12 months.
Yeah, the company also, it's working on closing its acquisition of Frontier Communications and also announced a new AI product that has to do with connectivity. Looking at some of the analyst commentary here, over at Citi, they said the results are positive, but they recognize Verizon will still likely be limited on postpaid phone volume growth given the higher share. In other words, it's a huge company. There's some cost cutting going on, but in terms of growth, it is difficult to do in the eyes of Citi at this size.
And Craig Moffett over at MoffettNathanson, well-known guy. Broadly speaking, he told his clients Verizon's fourth quarter results are about what the market expected. Same with their 2025 guidance, and he has a neutral on this one, and perhaps that speaks to the kind of action we saw in the stock today.
Let's talk about NextEra Energy. Those shares are rising despite reporting a miss on fourth quarter earnings. Company sharing on their earnings call, it plans to expand its natural gas and nuclear generation. And I think those are the two key items here. So first of all, signing a new partnership with GE Vernova to build out its natural gas powered generation. And Julian Dumoulin-Smith over at Jefferies saying that can more exposure to data centers thesis give shares a spark? Potentially, yes. So this would be so basically this owns Florida Power and Light. That's what NextEra does. And then they also have a power generation business that right now is mostly wind and solar. So this would be expanding more into natural gas.
Yeah, and reaffirm, it looks like several years of guidance. That always helps. CFO saying here, we will be disappointed if we're not able to deliver financial results at or near the top end of our adjusted EPS expectations ranges in 25, 26, and 27.
Yeah, one more quick note on that nuclear plant. The company is hoping to restart in Iowa. It put in an application with the Nuclear Regulatory Commission, and apparently the date at which it's trying to get that up and running again, 2028, again, according to that analyst at Jefferies, is a little bit sooner than analysts had been anticipating. So that also might be having matters,
Well, early 2025 looks a lot like all of 2024 for Boeing. Rough. The plane maker deciding to release Q4 earnings early, allowing investors to come to terms with a disappointing quarter, which many were expecting. Anyway, joining us now is Tony Bancroft, Gabelli Funds portfolio manager. Tony, it's always good to see you. So listen, Q4 was rough. I don't think that surprised you or the street, Tony. But what do you see ahead? Because when we last spoke to you, Tony, you were optimistic about this company's fortunes.
Yeah, great to be back, Josh and Julie. Yeah, I still am. I think, of course, that was probably a likely kitchen sink quarter. CEO's his first full quarter, and it's probably smart. He sort of accelerated the losses and got those out of the way. I think most of the bad news is behind Boeing. It's probably expected with the strike, and obviously the equity issuance that it was going to be a rough quarter, so you might as well just put those charges in. I think going forward, you're going to start seeing incremental improvement on production rates, and then with the new administration and the new Department of Transportation, hopefully selecting FAA administrator relatively soon, looking positively on Boeing as largest exporter to China. I think it's going to be a positive year for Boeing.
Tony, I feel like I've heard you say before that things are as bad as they're going to get. I don't know. I feel like maybe I've heard that from a lot of folks who are still positive on Boeing. How can you be so sure?
Well, the reality is that there's still, the fleet is going to grow by 44,000. They're going to build 44,000 planes in the next 20 years. The fleet's going to double. And it's essentially a duopoly. I mean, there's obviously China is trying to produce the COMAC, but I think that's going to take a long time, and getting those into Western, Western economies is going to take a lot longer with regulations. So you sort of have that backdrop going into it. IATA's just put out their long-term forecast for revenue passenger growth, growing 8% annually. So there's a lot of secular tailwinds going in Boeing's way, and just the industry's way in general. All the companies that which we own, a lot of which we own in our Gabelli Commercial Aerospace and Defense, GCAD ETF, and I think you're gonna see a lot of benefit going forward as you see production rates grow. It's a big operating leverage business, as I'm sure you can imagine. When those plants are idle, they're not making a lot of money, and there's a lot of costs, but when they're producing, that incremental jet is very, very, very beneficial and profitable to the company.
Tony, CEO Kelly Ortberg, obviously still relatively new on the job, but curious, Tony, just to get your thoughts on the job he's doing and whether he's placing the right bets. Is his emphasis or his priorities the right one?
Yeah, I think the CEO is a professional. He's been in the industry a long time. I think he knows how the aerospace and defense industry works. He's probably, been doing a lot of big ears and big eyes, seeing and watching, and he's going to come up with he'll come up with a plan. And I think he's probably already started that starting with this. We had two pretty big events in the last quarter, and I think from there it's a point of departure, and I think he realizes that first and foremost you've got to start producing planes effectively and safely, and I think that's where the focus is. The defense contracts are the next step, and they obviously took some big charges this quarter, but you've seen some news where they've renegotiated the T7 Air Force trainer contract with the Air Force to just get it there and make it more functional. These early development fixed price contracts are sort of difficult because early on you're still marching down the cost curve, and I think as that program goes on, you're going to see a lot more profitability and performance out of it.
Tony, I want to switch gears a bit here. I want to ask you just about the defense contractors. A lot of names reporting next week. A question I had for you, Tony, was about DOGE, Department of Government Efficiency, headed by Elon Musk. Of course, their mission, make the government more efficient. If you're an investor in these defense contractors, Tony, is that a cause for worry in any way? Should you be concerned that DOGE is going to ultimately result in cuts to U.S. military spending looking ahead?
Yeah, I think DOGE, there's a lot of talk around it, and I think it's important, and I think working on inefficiency is a constant struggle in any large organization, particularly the U.S. government. I don't think it's anything new. I think obviously when I was in the fleet and I was flying the F-18, we'd constantly be hearing better ways to improve on fraud, waste, and abuse. And I think it's just a standard practice of trying to make the government more efficient. So I don't think this is anything new. I think as it pertains to the aerospace and defense industry, I think the reality is on defense spending, and particularly, that's driven by the federal government, the Congress, right? Congress votes on it. And I think the reality is it's almost $1 trillion budget, and I think there'll be a place for these up-and-coming Silicon Valley defense techs like Palantir and Anduril and a bunch of others. But I think how the Defense Department works, all things being equal, you're going to see a lot of spending. Again, with the backdrop of the geopolitical uncertainty that's going on right now, you're going to probably see continued increases. You see, NATO obviously is still $44 billion behind its 2% target. So there's going to be probably a lot of growth coming for the defense industry. And there's probably, I think demand is well outpacing what is capable of supplying right now. So if anything, you're probably going to see a lot more spending increases in capex spend from the majors to keep up with that demand.
Tony, always great to see you and have you on the show. Thanks for joining us.
Thanks, Josh.
Stick around, much more market domination still to come.
President Trump signed a highly anticipated executive order on late Thursday, establishing a working group on digital assets that will be responsible for putting forward potential regulations for the sector and evaluating a national cryptocurrency stockpile. Our next guest, though, believes another rule that is being rescinded could be an even bigger boon for the industry. Joining us now is Mark Palmer, Benchmark Managing Director and Senior Research Analyst. Mark, it's great to see you. This rule, or really more of a recommendation, was known as SAB 121 from the Securities and Exchange Commission. It prevented banks from custodying crypto at their banks on behalf of clients. So why was that? I guess first set the table for us, Mark. Why was that such an obstacle for the crypto industry?
Yes, thanks very much for having me on. First of all, going back to 2022, when SAB 121 was first put in place by the SEC, it was clear that this was just another part of the agency's effort to stifle the growth of cryptocurrencies in the United States. And what that guidance did was force banks that would be interested in custodying crypto to account for it in such a way that instead of the assets being treated as separate from their balance sheets because they were not the bank's assets, they were the customer assets, and this is how it works with traditional finance across the board, the banks would have to record those assets on their balance sheets as liabilities and then reserve against them at the same time. Now, there were no banks that would be interested in doing that. It would throw off all of their capital and leverage metrics. So this effectively kept traditional banks out of the crypto space for the last couple of years. With the implementation of what's known as SAB 122, which rescinds SAB 121, the SEC has now given the green light to traditional banks to custody crypto, which in our view is a key to seeing widespread institutional adoption of Bitcoin and other cryptocurrencies.
Mark, in terms of those who were defending this rule, it sounded like when I read through the reports, Mark, Gary Gensler, for example, it seemed like he was saying, well, we need this rule to protect investors in case a crypto firm blows up. Was that the argument?
Well, what we're talking about here is, some of the bulge bracket banks and others that have been prevented from getting into the space. And what we're anticipating is that you will see some of the biggest banks out there get involved. At the same time, we had seen both the Senate and the House of Representatives last year vote to repeal SAB 121, but that repeal was vetoed last June. We also saw, though, that there were some exemptions made along the way for some of the biggest custodians that were out there. So the notion that customers would be protected by not going down this path doesn't seem to hold water. It just seems to be part and parcel of an overall effort by the former leadership at the SEC to throw sand in the gears of the crypto ecosystem and slow its growth.
Mark, something that always seems sort of ironic to me is the sort of the foundation of Bitcoin and of cryptocurrency and of blockchain is that it doesn't need TradFi, traditional finance, as people in the industry call it, right? And yet, man, they want in, right? They want access to that money. Have we just like basically that idea doesn't really, that's not relevant anymore, I guess. We've gotten rid of that idea, right?
Well, I think early on, it was very important to have passionate retail investors and folks who are truly focused on the decentralized nature of digital assets to be involved and to create a foundation. Crypto is that odd asset class where retail investors led the way in terms of adoption and institutional investors have lagged. But if we're going to see the crypto space reach its potential, institutions have to be involved. And in order for that to occur, we need to see infrastructure put in place. And a big part of that is custody. Crypto in particular is a bearer asset. Bitcoin is a bearer asset. If someone is to find another person's private keys to their cryptocurrency, they are effectively the owner of it. So there needs to be that level of safety and security. From an institutional investor standpoint, having the big banks there to provide that element is absolutely crucial.
Mark, thanks so much for helping us walk through the topic today. It's a complicated one. Appreciate it.
Good to see you.
All right, let's get to some calls of the day now. The street feeling bullish on Twilio, including Baird, giving the company a significant price target raise. They go from 115 to 160. The upgrade following Twilio's Investor Day. So by the way, Twilio, you can see the surge here. This is the biggest intraday jump since May 2020 for this one. They did report preliminary Q4 revenue growth that beat estimates. They authorized a $2 billion share buyback plan. That never hurts. Piper's Jim Fish, well-known veteran financial analyst, told his clients Twilio is seeing increasing traction and use cases around AI. He's overweight. Stock is now up around 90% over the past 12 months.
Yeah, it has just been a rocket ship, as you like to say frequently about these guys. Baird's William Power raised it to an outperform with that 160 price target, as we were just showing there. And he said after the company's investor day, he, quote, came away more confident in the company's ability to continue to drive double-digit revenue growth. And I also thought it was interesting the comments that Morgan Stanley made about the event, saying that it's not just about AI for this cloud communications company. It's also that they've got a good cross-selling plan. They've got a good go-to-market. In other words, their sales strategy is also positive in their view.
Yeah, big jump in the past 12 months. Although the long-term chart we just showed puts that in some perspective.
Yes, it does. All right. Well, Guggenheim downgrading GE Vernova from buy to neutral. The note highlighting a slowdown in upward revisions, and also just the idea, as the title of the note says, that the easy money has been made. In other words, GE Vernova's shares have outperformed. That effectively reflects the positive momentum in earnings that the company has seen, and then it's going to be a little bit tougher to beat the street at this point.
Yeah, stock now appears fairly valued. They did note some upside risks of their clients. They said, listen, this is leading provider of gas turbines. Those are in high demand, right? It's possible, they say, we may be underestimating the extent of their pricing leverage that would result in higher profitability, but that's not their base case here.
Right, exactly. And those shares a little bit under pressure today. All right, coming up, 4 of the Magnificent 7 companies report earnings next week. We'll be joined by an analyst on the other side to help preview what you need to watch for big tech. Stick around, much more market domination still to come.
It's a big week for big tech with 4 of the Magnificent 7 companies reporting next week. As the year begins, investors will be listening closely to commentary around AI spending in 2025. For more, we're now bringing in Ali Mogharabi, Senior Equity Analyst at West End Capital Management. Ali, it's good to see you. So I want to start, Ali, with Microsoft. And I'm specifically interested to get your take on Stargate. The Stargate project, obviously, we were talking about it, Ali. It was big headlines. It was Trump. It was very splashy. It's hundreds of billions of dollars being talked about. With Microsoft, what was interesting, Ali, was how they did change their deal with OpenAI, right? And so now the startup can use these, I guess, cloud computing services from rivals. So when you think about Stargate and Microsoft, was that, I mean, is this a win for Microsoft? Was the news flow to you, was it more mixed? I mean, how should investors be thinking about it?
Actually, I think in the long run, it was more of a win. It lessens their dependency on the OpenAI LLMs, right? And at the same time, which basically means that they can provide variety of options for their enterprise clients that are on Azure. And that's the way we should think about Microsoft when it comes to AI, is how well Azure and the Azure revenues are actually benefiting from all of that. So overall, I think in the long run, we'll see that was pretty much a net positive for Microsoft.
Well, what about in the short run? What about next week, Golly, when we get the numbers? Are we going to, we've been starting to get a little bit of stuff percolating through these companies' numbers, but are we going to get any real meat next week?
Yeah, well, I mean, while we're hoping, while the AI initiatives have actually resulted in continuing cloud revenue growth, we'd like to see more clarity on the app monetization side, right? So I mentioned Azure certainly benefiting from all of this, but again, more clarity on the app monetization side, the usage and frequency of those AI features that they've added, whether it's to their 360 or any other offering that they have. So I think that would represent another type of an ROI on all of these investments that they're making. They and obviously their peers are making in AI. And they've already talked about, I mean, $80 billion this fiscal year on capex is huge. And then, we also look to see if they're actually more aggressive on what's referred to as AI agents, right? Basically those agents that help developers develop various apps for enterprises. And I don't know if you're familiar with this, but we're thinking that, these AI agents could, to a certain extent, disrupt the SaaS model that we currently have. So, with Microsoft sitting there at the front, one of the leaders, we saw them, of course, transition to cloud very successfully. So hoping that, if the SaaS model is disrupted, that they will do the same thing utilizing their AI agents.
Can you help us quantify that Microsoft AI business, Ali? I mean, how big is it and how fast it's growing?
Well, we would basically go on the Azure side. So on the Azure, the cloud side of it, I mean, that's basically, if you think about it, it's driven mainly by AI investments and overall cloud transition continuing by enterprises wanting more AI features. So you're looking at basically between 25 to 30% top line growth still going forward. So that's the way we're looking at it. Of course, decelerating in a couple of years, but that's normal as overall AI adoption continues to increase.
Now, Ali, of course, we're going to hear from Microsoft next Wednesday. We're also going to hear from Meta that day. And speaking of capex, of course, that company just revealed that it's going to be spending $65 billion this year on AI infrastructure. But that's, again, the longer term. What is going to be the key thing to watch in that company's earnings report?
Well, let's put it this way. I mean, Meta is completely different than Microsoft, right? Meta has actually demonstrated how well it can monetize all of those AI investments. The ROIs on the ads that the advertisers purchase for all of those Meta platforms, whether it's Facebook or Instagram, the ROIs have continued to improve, and so the targeting improves. And they've actually, of course, deployed that AI to help the users more easily, more quickly create content. So with more content, you've got more interaction. You got users spending more time on those platforms, and that helps. That, of course, becomes even more attractive to the advertisers. So that flywheel, that network effect, has continued to improve. So what we're specifically, so that's not going to surprise us. We expect some good results on that front. But what we really want to see is more clarity on Meta's investments more towards the business-to-business side of a business-to-business model. So, for example, are they actually allocating a lot of that capital expenditure to developing their AI agents to move into that enterprise software side of the business. With WhatsApp, we think that there's a very good opportunity on that front. And then hopefully they can utilize their LLMs, which is widely used by developers out there because it is open source, to more aggressively market and implement their AI agents. And hopefully we can see some gradual improvement on the B2B side of the business.
Ali, another big name report next week would be Apple. This week we saw a couple analyst downgrades, Ali, maybe some skittishness about the company's business in China. Curious what you're expecting when the iPhone maker reports.
Yeah, I mean, that's already, great analysts have already talked about it. The iPhone 16, whether it's upgrade or sales of the iPhone 16 are not necessarily as good as everyone had thought initially. But this is Apple. This is basically a provider of an ecosystem that has billions of users and that continue to want to experience the new features that Apple has. So we just think that consumers are waiting for more effective AI features to be included in those iPhones, and we'll probably see an uptick in the sales of the iPhones later on this year. So hopefully we'll get more clarity from regarding that from Apple, and in terms of maybe additional investments, right, on the AI front, because that's where we think the company is lagging the other mega caps out there.
Great to have you on the show today. Thanks so much for your time. Appreciate it.
Sure.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
Here's the closing bell on Wall Street, and now it is market domination overtime. Let's see where the major averages ended the session here. Still in the red, down about 1/3 of 1% for the Dow, off 141 points. We did have consumer sentiment falling for the first time in 6 months today, and also perhaps just a pause at the end of a big week, a week that saw a record for the S&P 500 before today's pullback. Record closed yesterday, so that index down about 1/3 of 1% as well, and then the Nasdaq Composite off by about 0.5%. We also see some selling within the small caps, the Russell down 1/3 of 1% also. I was also looking at what's going on the sector basis here for the S&P 500. We've got tech and energy, the two worst performers on the day. Utilities and communication services up the most, but I also wanted to look at how we have done in this 4-day week since the inauguration and during this sort of optimistic rally about what the beginning of President Trump's second term is going to look like in terms of economic growth and for the markets. Of course, some relief being baked in as part of all of that, that we did not get harsher rhetoric and more specifics on where tariffs for China could go. Communication services, the best performers on the week, the XLC up 3.1%, followed by healthcare. We had some earnings, of course, over the course of the week from some health insurers. Industrials also higher in the week. In fact, the one group on the week that is in the red, the XLE, the energy ETF, and that mirrors what we saw, just going back over to the other screen, that mirrors what we saw in underlying oil prices here, which we saw lower on the week as President Trump talked about wanting lower oil prices here. And he did get lower oil on the week. So that not necessarily translating to good news for the companies that drove for oil if the prices are going down. We're going to start to get earnings from some of those companies towards the end of next week. Josh?
All right, Julie. The record-breaking rally on Wall Street hitting the pause button as the market was weighed down by weakness in chip stocks and investors gearing up for a busy week of data, plus the first Fed meeting of the year. Also in focus for investors, earnings. And our next guest says next week will be the true test for results. Joining us now is Eric Friedman, U.S. Bank Asset Management Chief Investment Officer. Let's start there, Eric, with earnings. We got big tech is on deck. What are your expectations? What do you think we're going to hear?
Yeah, we still think, Josh, this is a buy tech environment. You know, the IT spend that we're seeing, not just from consumers, but also on a business-to-business basis, continues. So our viewpoint is that, you know, companies are spending money, getting bigger, stronger, faster through technology spend, everything from data services to AI, of course, which is everyone's favorite topic. And so until that cycle stops, that's the place where we want to be allocating capital. Again, trees don't grow to the sky. There certainly has to be a viewpoint towards valuation, but we do think that as CFOs are spending, that's what they're spending their capital on. So that's really where we want to be positioned. So again, we still remain glass half full. From a full earnings basis, we're a little bit below the street for the full year. We think that, you know, this is a market that'll probably achieve something like $270 of operating profit for the S&P. That's about a 5-ish% discount to where the market is right now. So we do expect there to be a little bit of rationing back in expectations, but still think this is a market to own until proven otherwise.
Well, that's interesting, though, that you're saying about the operating profits for the full year. I mean, what could cause that rationalization? Is it just going to be the numbers come out and people realize they're not necessarily going to be growing as much as expected?
Yeah, Julie, we think probably the biggest catalyst is some bifurcation of the consumer level. We're seeing through not just macro survey data, but also through company earnings, that the lower income consumer and really the middle income consumer is starting to feel some pressure. Again, the aggregate of higher interest rates, the aggregate of higher costs is really starting to weigh in. So that we think will probably be more of a catch up to numbers in the second half of this year. Again, usually people are very optimistic about what the back half of the year contains. We do think that if interest rates hang in higher and the economy does well, but doesn't go off the, off a significant higher level than where it is right now, the consumers could be a little tapped out. Again, we're past past holiday season. And so this will be, we think, a real key test for just how durable that consumer will be. So that's probably the chief reason why we're a little below consensus on earnings. But again, still think that we'll get 12, 13% type of growth versus calendar year 2024. That's still a decent growth rate overall.
You know, Eric, President Trump this week signing a lot of EOs, executive orders. Interestingly, there was talk on tariffs, but nothing concrete there. I'm just curious, as a strategist, what you make of that and what it means for the market.
Yeah, the biggest thing for us, Josh, is we kind of think about what may inhibit some of the Trump agenda, so to speak. One of it, we think, will be what happens with interest rates. If you think about all the things that are being considered, taxes, tariffs, border security, and again, immigration policy writ large, that's a lot for any market participant to digest. Certainly there's a lot of rhetoric in Washington, but ultimately for us, it boils down to, does the bond market allow it all to happen? And we think that that's the principal governor, if you will, on the Trump agenda, will be what the bond market allows the Trump agenda to be, and also what happens with midterm elections. So I think that there is a little bit of a differential between what's said on the campaign trail than what happens in practice. And so a little more of a pragmatic approach to tariffs is probably viewed by market participants like us as a good thing. And so seeing that develop, again, sometimes as an investor, you buy things before an event occurs. We think that tariff policy is worth waiting on for us to be a bit more aggressive. Again, we're already running a little bit growth oriented in our portfolios to begin with. So to take that next step up in the risk curve, we'd have to have a little more clarity on tariffs. The fact that we've been a bit more pragmatic, we think is a good thing relative to some of the rhetoric that was present during the campaign season.
I'm curious, circling back to big tech, if you feel like that industry will be any more insulated if tariffs do happen or not, because they rely on chips that are imported as well.
Yeah, it's a really critical swing factor point. And I'd say that back to the idea, not that I'm a Latin scholar, but sometimes you invest ex ante, sometimes you invest ex post. And so the reaction function within the supply chain, we think, will be critical. Look, there's no surprise that a number of technology executives were on Capitol Hill during the inauguration and the days that followed, because what happens with tariff policy, what happens with supply chain reorientation, that isn't all done yet. And so seeing in particular that reaction function from CFOs. Again, we think that CFOs are going to keep spending on cyber, keep spending on big data technologies. That's very difficult to do if the goods sector is in some level of let's call it, there's just a lack of clarity on, can we get chips from point A to point B? So that dislocation, if you will, is a risk for us. Again, we do think the technology is a spot to be, but seeing how that plays off, not just from the initial announcement of tariffs, but also how other countries respond. We've heard that from Canada. We've heard that to some extent from Russia and from China. So again, this will be more of an ex post versus an ex ante investment environment on that front for us.
Thanks, Eric. Appreciate it. Have a good weekend.
Likewise. Thanks for having me on.
Investors' attention turning to the Magnificent Seven, of course, as several of the tech giants are due to report quarterly results. The big question, whether these names will add to the earnings season momentum. But for investors looking for a cost-effective earnings play, the options market might just be the place to look. Stockbrokers.com Director of Investor Research, Jessica Inskip, joins us now to discuss in the Options Playbook, sponsored by Tasty Trade. Thanks for being here, Jessica. So as we're looking ahead to earnings, I guess I would ask, first of all, what kind of activity in the options market are we seeing around the Mag 7 in anticipation of the numbers?
Yeah, absolutely. With options, with the Magnificent Seven, they're already high beta securities, so premiums tend to inflate. But around earnings, it's inflated even higher. And that's the way that the options market really gives us the path, if you will, as in we tend to look at the market as an up and down perspective. When we utilize options from an analysis perspective, since we have an expiration date, we can get an idea of path, which gives us a range of a deviation, which just is expecting from the Magnificent Seven large moves, but those large moves are up and down.
So let's drill down, Jessica, into one play, because you have an earnings play on Amazon with a synthetic long. So two questions, Jessica. One for the uninitiated, what is a synthetic long? And then walk us through the play.
Yeah, absolutely. So a synthetic long position means that it's an artificially created position to mimic a long stock. It's literally in the name. It's going to mimic and have the identical risk and reward of a long stock, which is unlimited risk potential, but also the same, or excuse me, unlimited reward potential, but the limited risk potential that is buying 100 shares of the security, because one options contract always represents 100 shares.
And why do you think that folks might want to consider positioning sort of positively then for Amazon? I know you shared a chart with us that was interesting. I found that was Amazon relative to the S&P 500, sort of on a ratio basis. Walk people through this chart and what you're seeing when you look at this.
Yeah, absolutely. This is a 5-year chart on a weekly basis. I personally look at longer timeframes because I'm a longer term investor, and we can deploy options to even be that way as well. When we're looking at a chart on a relative basis, I'm looking how Amazon in this case is going to perform relative to the S&P 500. And it had this key area of resistance that it has broken out of over a 5-year period, which is a big moment in time. When this happened earlier, when we had the big turnover in the overall market, it started with all of technology coming from a downwards trend. If you can just envision that now with Amazon, it follows the same thing. So this is another step which could lead to a leg higher. So it's a very big deal from a technical perspective, overcoming those key resistance levels.
You had, switching gears a bit too, Jessica, some thoughts about TikTok and that drama and how that plays out and how that could have ripple effects for Amazon?
Yeah, absolutely. TikTok is a key component of the creator economy. There's an impending ban, and we don't know what's going to happen there. However, creators are absolutely going to diversify. There is this shift in e-commerce. You can go on TikTok shop and shop via videos, and Amazon is actually integrated within TikTok, where you can do Amazon Prime without even leaving the platform. But there's also video reviews with that TikTok-like feel that is coming over to Amazon and is already in Amazon, so creators can diversify to that platform. It's unknown if it's going to be banned. However, short form is a great innovation, and that diversification could definitely translate over to earnings as ad spend moves over as well.
Okay, so Jessica, sorry, circling back to the synthetic long, in the case of Amazon, walk us through exactly how it would work.
Absolutely. So your first question was, what is the options market telling us? And when we are looking at options, it's derived from that underlying security, but there's also these other external factors and that implied volatility that gives us the move. When I am looking to use options to buy a security, normally we would deploy a cash secured put. So I'm selling a put. I'm going about 42 days out, try to get to the 45-day, very close to where the current market price is. So at the time when I pulled this, about 235 is the strike price. That means that I collect an inflated premium. By selling that put, I'm getting about $10, $9.95 altogether, but I'm obligated to buy the stock at $235 per share if it moves down. But the most that I can make is that premium of about $10. I don't want to go into earnings with a neutral or capped profit potential. And the way that I want to have this, or have more speculation and to have that unlimited reward potential or capitalize from a move from earnings, is by pairing this with a long call. And then that flips the entire profit and loss diagram to mimic exactly what you would see for a long stock. So if I buy the long call, same expiration, same strike price, that's going to cost me about $11.15. Altogether, I'm paying $1.20 per share to have that exposure to upside potential. So very, very little risk in comparison to the reward. And that's the way we can utilize options really to maximize our portfolio.
Jessica, appreciate your time and the trade. Thank you.
Thank you.
Stick around, much more market domination overtime still to come. U.S. stocks closing lower as investors weigh earnings and a week centered on Trump's return to the White House. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Let's start with week one of the Trump presidency. The second one, it was pretty eventful. We saw the S&P 500 reach its first record high of the year. So did the tech sector, large cap tech. So we're looking at XLK here. These are the 11 S&P 500 sectors plus the S&P 500 itself. And you can see tech came in fourth place here. And what's really interesting is that number one was communication services. Number two was healthcare. And let me just show you a development with healthcare. If we put a one-year trend line or a one-year chart on here, you can see it is now broken out of this negative trend line. So that's a technical development. Then if we go over to the leaders here, you can see XBI is the number one returner this week. That's 5.1%. That is biotech, by the way. And a lot of people coming into the Trump presidency wouldn't have thought, oh, hey, biotech is going to surge. But that is what happened. You can see it's traded roughly sideways over the last year. So a lot to do there. But check out number two. That's ARC. So you'd think about unprofitable tech. That is in the second place. And we got New York FANG to that in a second. And then China. China's number four. We didn't expect that either. So the point is, we see a lot of trends coming into the inauguration. A lot of times those just reverse. In fact, I went back to the first Trump presidency, and from inauguration through the first 100 days, we saw a big reversal in the US dollar. And that is my last point on this particular topic, Josh. I want to show you what happened in the US dollar index over the last 4 days. Couple big drops there, and if we take a look at the one-year chart, you're going to see it is nicely off of its highs. Might be a little soon to call this, but I am calling the top in the dollar for a while here. I think it's going to take a lot to exceed 110 on the index, and we're not going to have that catalyst for a while.
Now, what about our giant mega cap friends, some of which reporting next week, we know? Yeah,
so let's take a look at that, and that brings me to my second point, which is FANG. Remember the original FANG? F-A-N-G. That was back when Facebook was the ticker FB. That is actually outperformed the Mag 7 if you go all the way back to 2013. I presented this analysis earlier today, so you can check out the whole thing on our site. But I took the S&P 500 going back to 2013. It's up 300%. FANG is number one. That's up almost 1,600%. You add Apple in there, it drops to about 1,000. Magnificent Seven, it's a close second to FANG. And then Batman, well, that's up there as well. That's kind of a recent development. I don't know if you remember Batman from back in the day, but we get some Broadcom in on the action as well.
What are if you went under the hood, big winners within FANG?
You know, so basically 4 stocks here. That's all we got to worry about. I looked at Meta and Amazon. Those were each up more than 2,000%. Alphabet, Google, that was up almost 1,000%. Netflix was the decider here. It was up 7,800%, so almost 8,000. And it's really come roaring back recently. If you'll remember 2021, 2022, we had that bad bear market. It was down 75%. Since then, it is up 500%. So that recent comeback is why FANG is now number one.
All right, final Blickery point.
We got to take a look at Bitcoin and gold. Bitcoin is going to be trading over the weekend, and there's a lot of excitement there. So let's just take a look at what each of these assets are doing. And we got to go to a couple different screens for that. So let's hit gold first. Now, we got gold at about just short of $2,800 an ounce. This is what happened this week. Gold here is up 0.8%. You can see it closed the day short of that 2,800. If I show you a one-year chart, you'll see that peak right over here. But this is still a very bullish looking chart, and with some additional tailwinds here, it wouldn't take a lot to pop it above there. It could be anything with the Fed to any of these interesting reports we have coming on deck, maybe even some earnings next week.
Now, I can talk to Jared Blickery. I mean, if I'm talking Bitcoin and gold, we have to end, obviously, dollar.
Yes. Let's take a look at Bitcoin real quick, 105,000, and then we can talk the dollar, because that has really set the stage here for the next potential leg up in not only gold and Bitcoin. If you're looking for a catalyst there, a declining dollar helps both of those.
All right, Jared, thank you, my friend. Appreciate it.
Let's talk about a strong dollar as well. Another effect, it can wreak havoc as it makes U.S. products more expensive abroad, but the greenback's rise has been a tailwind for the major airlines as U.S. travelers head across the pond where their dollar stretches further. Joining us now, Yahoo Finance's Inez Frey, who's telling us it's maybe a good time to go on vacation.
Yeah, that's right. Maybe Sicily, maybe Palermo, maybe Southern Europe, because across the board, the three major airlines this month talked about the strong dollar and what that's done for transatlantic travel. Management at United said during their earnings call, Europe is an incredibly screaming buy for tourists, particularly Southern Europe, where the weather is pretty nice in the winter. That was Delta's management, by the way, saying that earlier this month. And the streets aren't so crowded in Southern Europe. American Airlines also echoing that sentiment, saying that the strong dollar is absolutely going to have an impact on buying travel, on traveling to Europe this summer. International travel has been strong for a couple of years now. Since 2023, we saw that the consumer was really opting for more experiential spending, and cross-border travel started to really take off. Now, this trend has helped push the airline stocks higher. You had Delta and United recently touching new highs. The European travel segment is so important that Delta and United took it one step further and said that they're seeing seasonality go away in the region, meaning it used to be that January to March were these off-peak seasons, but now they're seeing that people are traveling there all the time because of the stronger dollar. Yes, you've had a pullback, but still, it's quite cheaper to go now than it was a few years ago.
Really interesting. What are some of the other factors here at play, right? You do have premium seating, maybe that's picking back up, and also they've been expanding routes, I believe, some of the airlines.
That's right. So you've got premium seating, they've been expanding routes, there's more corporate travel, but really the route expansion has to be noted because you've got Delta and United that if you take a look at a map, they're going all throughout Southern Europe. They're looking at Bilbao, Spain. They're now having more routes to Rome, Naples, Sicily. You even have Nuuk, Greenland up north. You also have Marrakesh, Morocco. So these are all flights that take time to get there. You're going to most likely upgrade perhaps to the premium seats because if you're going to be paying $800 for the airfare, you may say, okay, $1,000 for a premium, then I'll do that. I'm going to be on the flight for 6 to 7 hours. One other note that I should make is that if you see a stronger dollar, then that tends to put pressure on commodities. One interesting point is that United last quarter paid 19% less for their fuel than they did in the same period the year prior. So.
Very interesting you put Greenland on that map.
I know, exactly.
If you want to take advantage of the stronger dollar and travel to Greenland, you better do it now.
Exactly.
Who knows what's going to happen there?
Don't know what's going to happen with Greenland.
Thank you very much.
Thank you, Ines.
Thank you.
Time now for what to watch next week. Starting off on the earnings front, big tech is headlining next week with reporting from Microsoft, Meta, Tesla, and Apple. AI investment will be a big theme again from those earnings calls. Meta and Microsoft both anticipating big years in capital expenditures. Meta announcing it expects to spend anywhere between $60 and $65 billion, while Microsoft said it would spend $80 billion for the year earlier this month.
And sticking with the Magnificent Seven, Tesla also reporting quarterly earnings on Wednesday. Analysts expect a strong quarter from Tesla's energy business, and investors will be looking for any new details about the company's anticipated Model 2 vehicle.
And finally, looking at the Fed, January's FOMC meeting will kick off on Tuesday. The Fed's interest rate decision coming on Wednesday. Federal Reserve Chair Jerome Powell will be giving a press conference after the decision, and Yahoo Finance's coverage of the Fed decision on Wednesday will begin at 2 p.m. Eastern.
That'll do it for today's Market Domination Overtime. Be sure to come back on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's the best moments from Yahoo Finance's coverage of the 2025 World Economic Forum in Davos. Be sure to scan the QR code below to check out all our conversations from that landmark event.
But for now, we leave you with the best moments from the past few days here at Yahoo Finance. Have a great night.
It's January, and that means the World Economic Forum in Davos, Switzerland, and leaders here are congregating to talk about the future of climate, the future of AI, the future of business under new President Donald Trump. Be sure to tune into Yahoo Finance all week as we talk to these big newsmakers. One of the persons we always talk to at Davos, that is Salesforce co-founder and CEO Mark Benioff. Mark, good to see you. This is not going to be a podcast, so I don't have tons of time with you, unfortunately.
Great.
So let's come out of the block blasting on AI.
Faster the better, actually.
Faster the better. Okay, faster the better. AI, what's the job market impact to AI?
Well, technology is always getting lower cost, easier to use. It's going faster than ever, but, technology is always impacting jobs. And so we're going to have changes in jobs. And we talked about this already, like just at Salesforce, for example. We've put Agentforce on top of our customer support platform. We have 9,000 support agents. We get about 36,000 customer support inquiries every single week. If you asked me a month ago, I'd say about 10,000 of those had to go to humans. Now with Agentforce, only 5,000 are going to humans. So I can now rebalance those customer support agents, and I'm going to ask them to move into different jobs inside the company where I have a lot of needs in other areas. So this is an exciting moment.
Is AI beginning to eviscerate departments in companies like HR?
No, I think that's not true. No, I think it's making us more productive. It's giving us the ability to augment, our companies in new ways. I'm wearing this vest from Gucci that I just got because I was in the Florence call center, and we put in our Agentforce platform. It augmented those employees. Their revenue went up 30%. The call center agents knew how to sell products, so they can do things that they could not do before. That's a very exciting part of what's possible now.
Do you think the workforce, the global workforce, will be massively, do they have to be massively retrained to work a lot of this technology coming at them?
I find that I am retraining myself. Like I'm working on my business plan for fiscal year 26 that starts February 1. So I'm actually working on writing the vision statement, the values, the methods, how I'm going to accomplish all the things. I want to make every company an Agentforce company, the obstacles, the measurements, and I'm using AI for the third year in a row to do that. So I'm working with the AI, I'm talking to it, it advises me. I ask it about how what I'm doing compares to my competitors, where my gaps are, how I should fill in, and it's been amazing, but I've had to learn how to do it. And as an example, I'm bringing an executive with me this year, and somebody new who's never worked on with me before, and they were just kind of sitting there with their mouth open, not understanding how I was working with the AI to achieve my goal. So I think that for all of us, whether you're a CEO, a journalist, or a support worker, a sales worker, marketing worker, no matter what you're doing, you're going to have to reach a doctor, radiologist, you name it. Everybody's going to have to retrain themselves to be productive with AI.
Two questions. One, you've been keeping a running tab on how many Agentforce deals, and you've shared that with me in the past. How many deals have you signed, and what is the
We're in the thousands.
All right, what is the thousands now?
We're in the thousands.
That's
huge.
Well,
we did 200 in
I just talked to you a couple
in
months ago.
I know. Well, this is going way faster than anything we've ever done, and it's been amazing, and it's very exciting. And look, I'm shocked at how fast it is going, but here at the World Economic Forum, they've used our platform for more than a decade to run all of the sessions and contacts and how everybody finds their way through this. But this is now an Agentforce operation here, and it's agents and humans working together in Davos to make a more successful Davos. I just showed you the app.
Yeah,
so
wild
were
app.
You surprised?
Yeah, I was surprised. I was surprised by the speed, Mark, of how fast things come up. And to that end, what is the consumption? Like people that now have agents in their business, what's the consumption? How aggressively they are using this technology day to day?
Well, I think that, a year ago, nobody had anything like this or could even conceptualize doing anything like this. So we are at the beginning of an incredible journey for every company. And every CEO that I meet with, I just talk to them about, hey, what's your path to becoming agent first? How will you build an agent first organization? And I'm trying to model myself and show that I'm doing that.
I'm sure you saw the news, Stargate, AI infrastructure fund by the Trump administration, some Microsoft, Oracle, all those names are in there. Were you involved in that, and what signal does that send to the tech community?
Well, Larry Ellison, I mean,
mentor, right?
was a huge mentor of mine. I worked at Oracle for 13 years before I started Salesforce over 25 years ago, and I'm very proud of him. He has a vision for curing cancer. You saw it all play out. He's talking about it now quite openly, using AI to do it. He's taken a lot of the research ideas that have come out of his institutes in Los Angeles and Oxford, and now he is putting it into action, and I hope he's very successful and that all of us will benefit from his ideas.
Do you think that Stargate is a good signal that this will be a tech-friendly administration?
Well, I think it's going to be a much more business-friendly administration, which is not that difficult compared to the last administration, where there was no embracing of business at all. There was no discussion of how to amplify. Probably one of the great assets of the United States is our technology companies and our technology leaders. And at a moment in time where the whole world is becoming augmented by artificial intelligence, the United States has an incredible lead right now. It's very exciting, and I think that the administration should work closely with all of these CEOs so that we're able to be successful globally. And this is very important, that the government is part and parcel with what business is doing.
Are you concerned that President Trump, I guess, rolled back the AI guardrails that President Biden tried to put in place?
Well, I think we're still at the beginning of the administration. We don't know where all of this is going yet. So I think, as you know, I practice a beginner's mind, shoshin, the Japanese word for beginner's mind. And right now, at the beginning of this administration, I think it's best if we have a beginner's mind to see where everything is going. I'm very optimistic about what's possible. They have some incredible people working on this.
I remember you telling me, maybe last earnings call, Brian, agents could be used in government. Have you talked to Elon? Say, hey, we got to get these agents in government. They could be major cost savings?
Well, you're right. Agents in government, every government is going to, every company is going to benefit by being more agent first. I know that when I'm working with whether it's my state government or with my federal government, I never have somebody to talk to. So if I can talk to an agent, I'll be happy that I can actually get some of these issues finally resolved.
Lastly, of course, the World Economic Forum has always been focused on climate, and you've been a champion in this area. I think back to when you was working on planting 1 million trees.
5 years ago, we launched the Trillion Tree Initiative.
Trillion trees. I can't believe
trees.
It.
Yeah.
This administration is rolling a lot of those things back. I mean, does that set back the world as we refocus on drill, baby, drill, and using more fossil fuels?
Well, I'm optimistic that we can work on things that are important, like the trees, the oceans. This is really important to me. I think that, again, in the Biden administration, we didn't see them really support work in the fundamental preservation of the ocean. We did see them work on the trees, though. So we saw them continue the work of Trump, where the first Trump administration, carried through, where we've had a lot more commitments to, making our trees healthier and better, and restoring and planting, and I hope that we're going to get something with oceans as well.
Mark Benioff, Salesforce co-founder and CEO. It's always a treat to get some time with you. I appreciate it.
Great to spend time with you, Brian.
Thank you.
Thanks for having me again.
Appreciate it. That's it. We'll be right back on Yahoo Finance. Yahoo Finance on the ground at the World Economic Forum in Davos, Switzerland. Of course, at Davos, actually it wouldn't be a Davos without a big presence with AI companies, technology companies. Let's get to one of those tech companies playing in both spheres. That is HPE. Antonio Neri, CEO. Good to see you again. Feels like we're just here, but you know, it's a year later, right?
It's a year later, and always great to be here. Thank you for hosting me.
Yeah, it's. I just got off. I just moderated a panel at breakfast, and what surprised me is the pace of innovation on AI. This panel was, our discussion was on AI. Have you been surprised by how fast things are moving?
I got surprised at the beginning, right, when we kind of achieved the breakthrough with the first ChatGPT. But as we provide, you know, a lot of the infrastructure and the services to train or inference this model, I became less surprised. I think now we are looking, what is the next big inflection point? We talk about answering questions through prompt engineering and feeding more documents to train these models. Now we're moving to more the agentic model, which is basically stitching together different agents that are good at specific tasks to basically provide an outcome out of our workflow. And now obviously the next big thing is the reasoning. And so the question is how long it takes from what we know today, which is statistical driven, answering questions on the documents we fit this model into, to more reasoning. And I think that will take a little bit of time, but the technology is there, the compute power is there. And I think, you know, it's just a matter of time to get to that outcome.
How can a company build trust into AI?
Well, I think it starts by focusing on the right governance, right, and the right principles. Even ourselves, to give an example, we have more than 200 use cases that we think with our team. 40 of them are already in production, and we continue to ideate and test. And in many cases, I call it, you know, fail fast and improve, right? So you fail in some of the use cases, no problem, move on. But ultimately, you have to have a governance and a steering team that think about ethical principles, responsibility, sustainability, lineage of these models, where the data is coming from, the provenance of the data. And you need to create a culture around it. So I don't think it's just a matter of process, it's a matter of culture and learning and improving and moving on.
Another tech executive that I spoke to said AI may not be able to be regulated, but it could be legislated. What do you think about that?
I think that person is right. But as I always said, when there is massive technology disruption like we're seeing today, you know, my generation's seen it all. In fact, I was reflecting the other day, all the inflection points I was able to live through, from, you know, no computers to PC, client servers to obviously the cloud and the mobile capabilities we have today. I think, you know, this one is going fast. If you think about it, when we went through just deploying phones in homes, it took decades to get to 50 million users. ChatGPT had 50 million users in 1 month. So the ability to regulate this is very hard, but I will say the private sector has the responsibility to come to the table with the public sector, the legislation side, to provide the input so that the legislation take care of what needs to be done from a society perspective, from a country, national security perspective, at the same time making sure the advancement of these technologies are not held back, because fact of the matter is going to happen one way or the other one. We've seen it over and over.
I've had, I thought you were born during the internet boom. No?
No.
Mid-90s?
A little bit older than that.
Okay, I just wanted to get that.
Way older than that.
Just wanted to clear that up.
Yeah.
I've heard a little bit of everything on AI this year. I've heard humanoids. I saw a humanoid dog come up to me on the promenade. It was really weird. I think it was by DHL, the shipping company. Strange stuff, Antonio. But then I heard at an ADP dinner on how it really may fundamentally change jobs. Is the reality that AI is already out of control and regulators they can't do anything about it?
I'm not sure it's out of control. I think there are use cases that sometimes people want to showcase either in their own benefits to say, hey, this is the potential. But the reality is that enterprises are very smart. I spend more than 50% of my time with enterprises all over the world, and they have a very responsible approach to what they are doing. First, because they need to understand the return on investment on this technology. This technology is not cheap, it's expensive. So CFOs and CEOs have a lot to say, and also making sure that the way they do business has some sort of conduct around it. Second is that, when you implement these technologies, you understand the implications to their customers and how it's impacting them. So I will say, yes, there is a lot of hype about the potential, which I do believe in the potential, but we need to funnel that potential in things that advances the enterprise or solve some of the societal challenges. And then from the consumer perspective, it's up to you to decide how much you want to consume.
Before I let you go, did you win that deal with X?
We don't comment on customers because it's a privacy issue, right? And at the same time, we want to first deliver on our commitment, then we can talk about which customer it is. But I have to tell you, we have a very large mix of customers that come into us for their infrastructure needs to train or inferencing these AI models.
All right, we'll leave it there. HPE CEO Antonio Neri, good to see you as always. Dow Finance continuing its coverage at the World Economic Forum in Davos, Switzerland. Of course, there is no small presence of the tech industry here at this conference. Let's lean into all things tech with HP Inc. CEO Enrique Lores. Enrique, good to see you. You brought the snow with you, man.
I did, but great to be here with you.
Yeah, good to see you. We were doing good here all week. No snow. We were just like firing off these hot headlines, and life was beautiful.
Davos would not be Davos without snow.
Yeah,
so.
that's very true, sir. I want to put some of these questions that I put to your friend Antonio Neri at HPE. He sat in the seat a couple minutes before you. AI governance. Is it hard to bake into this technology given how fast things are moving?
I think it's hard, but it's necessary. And I think it's something that all of us that are involved are willing to do because we know that the potential bad consequences are not having some governance. So I'm confident it will happen, and many companies are having the right conversations, engage with governments. So I think over time it's going to be put in place.
How is AI impacting HP internally?
We have a lot of projects driving changes in how we work to increase efficiency, to improve customer satisfaction. But the most important change is how it's helping us to shape our portfolio. We are focused on defining the future of work, and we think by integrating AI into all of our products, enabling customers to run AI at the edge, doing inferencing on the edge, we can really help both to drive a significant productivity improvement and also help employees or help users to get much more satisfaction from the work they will do. So that's really the priority for us as a company now.
I remember I sat here a year ago and asked you about AI PCs, but I was thinking about today, you do other things besides PCs. Like, how do you bake in AI into printers or even camera technology?
I mean, it's going to be a big differentiator for us. Just think about cameras that will be able to identify who you are, to connect with your PC, to provide a better experience in a conference room. Or think about printers that will know what you really want to print, even if you send the wrong file to the printers.
I don't know if I really want that.
I think you do. How many
Okay.
times have you printed a spreadsheet, and because you didn't put the right borders, you get multiple pages in a format that you didn't want to, that really was not easy to read? The printers will be able to understand what you really wanted, and before printing, they will tell you, Brian, did you really want to print this, or did you want to print this? And then you will have the choice of printing the right format.
Well, hang with me on that. Means less ink. That means like I don't buy ink from you guys as much, right?
But this will mean higher customer satisfaction, which is our priority.
And then I buy my next printer from you, right?
Eventually, yes.
How far away are some of these technologies in your products?
So, like on the printing side, by the end of the year, this will be available in the market. So, we are driving this as fast as we can. You ask about AI PCs. AI PCs now are in the market, and we started to ship them a few months ago. AI printers will be at the end of the year. So, all this is really changing fast, and we are really driving this change in the industry.
How do you think AI changes the future of work outside of just outside of the hardware component?
I think it's going to be a radical change. I think how every individual in a company works is going to be different. And this is the work we are doing. We are going persona by persona in the enterprise, understanding the workflows and the applications they use today, and how they will be transformed with AI, and how with AI PCs, with AI printers, with AI conferencing rooms, we are going to be able to influence and change that work. It's a big part of the future of the company now.
When is that? Is there is there a super cycle, I guess, upgrade cycle for some of these technologies, or is it incremental?
I think it's going to be gradual because hardware is available now. Software applications are going to be available over time because all of them are working on different releases. So as companies will see the new applications available, they will understand the impact this is going to have, and this will drive adoption.
I had a dinner here with a board member of Best Buy, and they were saying they spend 50% of their board meetings talking about tariffs, and the number really blew me away. 50% of a board meeting on tariffs. I mean, what's the impact to your business? I mean, I try to decode a computer and like what's inside of it. I mean, what's the impact of them?
I mean, today what the impact is going to be is still hard to know because we don't know exactly what tariffs are we going to be put in place. But we have been working on this for several quarters. We have now multiple scenarios, and as soon as we know what the final plan is going to be, we will put one plan in place or not. This is something that we have learned over the last years how to manage. Yeah. So I think we have now good expertise on how to manage that in a way that will create a minimum impact on our customers.
In terms of when you make a printer or a computer, the components inside, where are you relying on China? Like what products come from China to make these products come to life?
Still, especially on the PC side, China is a big manufacturing place for us. But over the last couple of years, we have been diversifying that because we learned during COVID that cost couldn't be the only driver of our supply chain. We needed to improve resiliency. And as we have talked before, we have been aggressively improve our resiliency, moving manufacturing sites to other parts of the world. So now the situation is much more balanced. And we think that compared to other companies in our industry, we are in a much better position.
But even if you're able to get out of China, a tariff would mean a higher computer price. My printer will cost more, no?
Over time it will. There are many elements that have an impact on price. Tariffs could be one of them. And again, once we know exactly what the tariffs and what the location and the amount, we'll see kind of what the impact may or may not be.
I was talking to the CEO of Suntory, a big global whiskey company, and he told me, let me see if I get this right, they have stockpiled enough whiskey in Europe because of tariff fears for a year. So somewhere in Europe, in Suntory in warehouses, there's a year of whiskey. I'm like, you gotta be kidding me, dude. But are you stockpiling components or computers or anything in advance of something like this happening?
We did some increases of our own inventory during the last months.
Like components or actual computers? Like
in our case, it's more final product, not so much components.
Gotcha.
So to mitigate the impact at the beginning. So we have done some of that, of course.
HBN CEO Enrique Lores, always good to see you. Appreciate it.
Likewise.
Thank
Great
you.
to be here.
All right, do stick around. Much more ahead on Yahoo Finance. Y'all find is on the ground at the World Economic Forum in Davos, Switzerland, and lots of focus on the incoming Trump administration, what that may mean for markets, what they might mean for the world's biggest banks. Speaking of banks, we're here with Bank of America Chair and CEO Brian Moynihan. Brian, good to see you.
Good to be here again.
No jacket as always.
No jacket. It's nighttime. It's a little cooler out here tonight, but it's fine.
Fair enough. So President Trump, newly inaugurated, promising this will be a new era of prosperity for the country. Are you on board with that?
Well, I think in the end of the day, if you speak from the business community, which largely, we have thousands and thousands and millions of business clients, I think they believe there's an opportunity here that the tax regime will stay in place, which is an advantage in the United States, that the regulatory environment will move back to the center, and that the opportunities off of that, because the President of the United States, are high, and I think that's given enthusiasm. And that to me is, from the business side, that's the major part of this message, which is less regulation, tax regime stable, investments in America, and for mid-sized companies and small companies in America, that's great news.
I remember you telling me at our Invest conference in November, you were concerned about deficits and how they've ballooned. Can the administration push through tax cuts and what it wants to do, given where deficits are?
I think the tax cuts will be hard because where do you find the revenue to cover them? But maintaining tax rates, it's going to take some spending reduction. It's going to take some views on how they spend money, where they spend money. It's going to take some, hopefully some more growth to grow your way out of a little bit. It's going to take, and the predicted growth is higher, and it's going to take other activities. But backing up, I think the incoming Treasury Secretary in his hearing made it clear we've got to get this debt balanced out. It doesn't have to go down. It just has to flatten out against the growth of the economy. And I think having a strong economy is the backbone of that. And then getting people to invest and create even more jobs and more growth is the backbone of that. But we've got to be careful. We've got to get this a little bit more rational. And that's, to me, that's one of the biggest issues America faces alone. There's worldwide issues, wars.